Hello and welcome to this presentation of Name That Chart. This is the Specialist Trading Weekly Stock, E-mini, and Forex lesson. Hello everyone and welcome once again. My name is Primo. I am the president and founder of Specialist Trading, and we've taken the title of this week's lesson from an old television show that was called Name That Tune. And in that show they would briefly play a small portion of a song and ask you to name that tune. Well, we're going to do the same thing today and show you a portion of a chart and ask you to name that chart. But before we begin, as always, we ask that you please take a moment to view our disclaimer. I'm going to show you some performance results and looking at charts, but please remember that we can in no way guarantee that any of these results will be repeated in the future. So please take a moment to view our disclaimer, and then we shall begin this week's stock, E-mini, and Forex lesson. Alright, this lesson this week is called Name That Chart. And here's the chart we're talking about. We haven't given you any of the specifics in terms of price or time frame, but we're just basically showing you the exact chart in terms of what is shown in terms of the two lines. One is the chart here in red, and the other is the moving average. And the thing we want to point out is really the basis or the philosophy behind specialist trading, and it's using our buy-sell line, or how price reacts in relation to its moving average, or the buy-sell line, meaning the 50-period simple moving average. Now, as you can see, when price, as represented here in the red line, is above its moving average, it continues to be acting better than normal or above its average, and that's when you want to be long, or that's when you want to be participating in it. But the minute it goes below the moving average, that's when it's telling you, giving you a clue that price is not acting above its moving average anymore, or above its performance level. It's now below its performance level. It's below average. So now you should either be sitting on the sidelines or you should be aggressively shorting it, no matter what the chart is. Now, I'm going to give you a little bit more information, but I'm going to show you how this phenomenon works in virtually any market and in any time frame, and then we'll come back and address this chart and see if we can figure out exactly what it is. But we're really more concerned about just this reaction here, how price acts in relation to its moving average, and how it can actually help you by giving you a clue as to the direction of whatever market and whatever time frame you're looking at. Here's a perfect example. Let's start off with stocks. And we see here that Netflix on a weekly chart was doing rather well coming into 2012, and then as you can see at the latter portion of 2011, it fell out of bed on a weekly chart. Now, how could we have taken advantage of this, or at least not lost any money if we were an investor in Netflix? Well, we've plotted the 50-period simple moving average in green, and we see here that once we had consecutive closes, 2 or 3 closes below that, the market in Netflix was giving us a clue that most likely the trend is going to change and we are going to be performing, or underperforming I should say. So you really don't want to be in a stock, or anything for that matter, if it's underperforming its average. So that was the clue that Netflix was giving you at the end of 2011, beginning of 2012. And you could have saved all that money had you sold your stock, and in fact made a lot of money if you were an aggressive trader and gone short. So remember, when price is above its moving average, that's when you want to be in it or involved or going long looking for buy signals. When price is below, that's when you want to be out of it on the sidelines or looking for sell signals. It's that simple. And once again, this does not just pertain to stocks. This phenomenon goes over into any market in any time frame. Let's see how it applies to the E-mini S&P on a 1,000-tick chart that happened just about a month ago. This was in mid-August, and we can see here on a 1,000-tick bar chart, we've plotted the 50-period simple moving average. Once again, when we had some consecutive closes below that, this was the market on a intraday time frame basis giving us a clue that most likely we're going to be changing directions, and that we should, if we're long, either move our stops up or think about exiting our long position in the E-mini. And as you can see, that was a perfect position, a perfect time to change directions, and it did. And once we were well below the 50-period moving average, it was straight down after that. And if you were on the sidelines, you could have saved a lot of money not being long, and if you were an aggressive trader, you could have looked for short opportunities. Once again, if price is above its moving average, it's telling you that it's performing, it's overperforming. If it's under its moving average, it's underperforming. So you only want to be long when something is above, and you only want to be short when something is below. Lastly, let's go to the Forex markets. Let's see if this phenomenon still works there. Let's look at a daily chart of the Canadian dollar, I believe. Yes, US Canadian dollar. Here's our 50-period simple moving average that we plotted. Once again, as you can see, If price is above, that's where you want to be in the Canadian dollar, and once price goes below, that's where you want to be out of it. Now we look for some consecutive closes below the 50-period simple moving average, and that's where the market in the Forex was giving you clues as to get out and to start looking to go short, or at least be on the sidelines. But no longer do you want to be long in the Canadian dollar. This was in actually June of, or I should say July of this past year. And this is a current chart up until this past Friday, Friday the 14th of September. So had you been long, you would have done very well until we had some consistent closes below the 50-period moving average. That's where you would have either exited and looked to go short if you were an aggressive trader, and then you would have done even better on the short side, because we traversed straight down after that, and that was roughly at the end of July, beginning of August. All right, so you see how this pattern, how this type of action, this type of behavior runs through each and every market, regardless of the time frame. We looked at a weekly chart, we looked at a tick chart, and then we looked at a daily bar chart. And they're not going to always be as uniform as this. They're not going to be as simple. Many times you will have some type of whipsaws and some type of back and forth. But as long as you really apply this basic philosophy, you'll really have this consistency in your trading, and you won't get caught being long when you actually should be short, and vice versa. This will help you become consistent in your trading as long as you apply this simple rule that if price is above the 50-period simple moving average, price will continue to go higher, and you should be long. If price is below, most likely price will continue to go lower, and you should be short. Now, let's name that chart. Can we name this next chart? This is where we originally started the presentation with. Remember, we're talking about behavior where price is above its moving average, it continues to be going higher, and if price is below, it continues to go lower. I know a lot of you would think, well, boy, this is some stock that really fell out of bed maybe during the crash, or this type of behavior happens a lot in the Forex markets or even the Emini. I don't know if this is actually a stock per se. Well, remember, what we want to stress here is not so much what the chart is, but just that this phenomena works in every time frame, in any direction, and in any market. And it also works in different categories, because as you'll see here, this is not a stock, Emini, or Forex market at all. It's the summer daily maximum temperature of Central Park in New York, going back from 1902 to 2011. And I just wanted to show you this, not to trick you or to show you that you were wrong in what you were thinking, but to really express that this phenomena, this behavior works in everything and anything. So when price or temperature, whatever you're looking at, is above its average, that's when it's going to continue most likely in that direction. And once whatever you're charting is below its average, that's when it's most likely going to continue in that direction, all right, in a downward direction. So this is a very simple and easy way to improve your trading and give you that consistency. All right, as we conclude this weekly stock, E-mini, and Forex lesson of naming that chart, remember, everything starts first with the strategy. You must understand the strategies and understand the rules before you can start heightening it by adding different tools and different types of techniques. The way to get to consistency through our specialist edge is through paper trading. So paper trade first, regardless of what market, regardless of what time frame. Paper trade for a couple of weeks, a couple of months, doesn't matter. Just as long as you fully understand the process and how it unfolds in real time. Remember, should you have any questions, feel free to email me at stephenprimo@specialisttrading.com. In closing, I ask that you take one last look at our disclaimer. We show you how to use the 50-period simple moving average and how it can work in any market, in any direction. So we showed you some performance results with that. But please remember that we can in no way guarantee that any of these results will be repeated in the future. Thank you so much for attending this lesson today. We shall see you right back here next week with a new stock, E-mini, and Forex lesson.